you want an exposure to a market or an
Everything they need in one place.
Be the world's foremost authority on
Individuals, advisors and institutions.
Hello and welcome to Morningstar. I'm Emma Wall and I'm joined today by Alan Good, Senior Equity Analyst for Morningstar. Hi Alan.
Hello, how are you today?
Very well, thank you.
Good.
Oil, big topic, very popular subject. You've just given your talk at the Morningstar Investment Conference Europe. Morningstar analysts have recently downgraded their oil price forecasts. Where are we looking at now?
So previously we were using $100 per barrel oil. Now we're using 75. And the basic reason behind that is because we think the potential of U.S. tight oil, its size, the amount of production, and then ultimately its cost, mean that we can meet a lot of supply without having higher prices. So if we look at U.S. tight oil, most of it's viable below $60 per barrel. And the size of the resource is also much larger than we previously thought. So by 2020, we think we need about 6 million barrels per day. 40% of that can be met by tight oil, and the remainder can be met by supplies under $75. So ultimately, we don't think you need $100 per barrel oil anymore to meet global supply.
So this isn't so much about the fact that we've seen the Brent crude come down from $110 to $55 again this week following Janet Yellen's speech. It's more to do with forward-looking supply and demand.
Absolutely. I would say the one key change that we've seen over the past year is OPEC's unwillingness to step in and cut supply in front of the market. And so they were losing market share to the U.S., and as opposed to cutting supplies, increasing prices, and effectively subsidizing the U.S., they decided to let the oil market really be a market. And as a result, you don't necessarily have that price floor that we historically have. So at the end of the day, it all comes down to supply and demand and cost of supply. And the fact is that cost of supply is a lot cheaper than it used to be.
So looking then at equities, you're an equity analyst. Obviously, oil is going to have a big impact on oil stocks.
Yes.
It's going to affect the fair value estimate and the economic moat as well. I mean, how have these stocks fared now?
So stocks actually collectively haven't fared all that poorly. Oil prices are down about 50%, but if you look at a couple of the indexes, they're only down 25%. Now, granted, if you're a smaller player and you produce 100% oil, you're likely to be down 60 or 70%. So we do think there is opportunity, even if you assume oil long-term at 75. Our preference is always for quality and valuation. So we like firms that have low-cost assets that can generate excess returns, or in our words, in Morningstar words, have economic moat, and even have an economic moat at $75. Now, granted, not as many firms have an economic moat at $75 oil as they did at 100. So we have reduced moat ratings for several of our E&P names and several of our integrated names, particularly the European major integrated oils. Shell, BP, Total no longer have moats in our opinion. So what we're looking for are moaty names that are undervalued. And when we look across that screen, in the integrated side, we do see Exxon as a viable candidate. On the services side, we see a Core Labs or a Schlumberger. And then on the E&P side, we still think BG earns an narrow moat. And even Tullow, which has had its own difficulties, still has low-cost resource that is undervalued by the market.
And why in particular have those European names been hit more than the US names? Is it because we don't have sources of shale oil and gas in Europe?
I think that's part of it. I mean, I think if you look at the larger tight oil players with the better quality position, their shares have held up better. But also, if you look at individual names, they all have their issues. Tullow has a relatively high debt level, but we think it's manageable. BG's had some execution issues. If you look at some of the European majors, they have European refining, which has been challenged as well. So, every company typically is going to perform differently in the oil price environment. Yes, they're all impacted, but balance sheet, asset quality, company-specific issues are going to determine share price performance as well.
And quickly on the flip side of that, who's still too overvalued, would you consider, given the backdrop and has lost its moat entirely?
Yeah, so I mean, we don't think there's a lot of firms out there that are very overvalued at these levels. We just think there's less opportunity. But if you look at Total, as I mentioned earlier, they're a firm that we think are slightly overvalued that have no moat. A lot of the drillers, like a Seadrill, who are heavily levered to offshore activity, which again falls on the higher end of the cost curve. These firms have a lot of debt, and there's an oversupply of offshore rigs. So those firms not only have no competitive advantage, in our opinion, but also are overvalued as well.
Alan, thank you very much.
Absolutely. Thank you.
This is Emma Wall for Morningstar. Thank you for watching.